The 20 Greatest Economists. Adam Smith, considered the father of classical economics, was also a moral philosopher who defended concepts of right and wrong. The Wealth of Nations is regarded by many economists as the foundation of contemporary economic thought. The main thesis of the book is to leave the economic process without interventions of the government, whose only activity should be to preserve order performing routine functions, making a clear case against the mercantilist practices of many European countries. Adam Smith, with another contemporary economist named Alfred Marshall, introduced the concepts of supply and demand. This law of supply and demand is a theory that explains the interaction between sellers of a resource and the buyers of that resource. This great economist was opposed to the mercantilism practices that believe a nation is richer due to its accumulation of profitable balances, which government should encourage by means of protectionism. He establishes that it is the individual's self-interest and freedom of production and consumption that benefits the society. The first chapter of his great work, or magnus opus, emphasizes the theory of division of labor, which divides the production process into different stages, enabling workers to focus on different tasks. Adam Smith asserted that 10 workers can produce many more pins if each of the 18 specialized tasks was assigned to a specialized worker. Smith uses the metaphor of an invisible hand that acts as unseen forces moving the free market economy. This invisible hand allows the supply and demand to fluctuate, drawing the market to equilibrium. Even though he was a moralist, he concludes that the society benefits socially and economically from the self-interest of individuals. The invisible hand concept received critics that point out that in some cases, the motivation of people is guided by greed. But in the book, the word greed is used only once by Adam Smith. The forces of self-interest and competition are opposing and complementary forces. Self-interest is pursued without regard to others, and it is normally assumed that individuals are primarily motivated by self-interest. Adam Smith believes that the benefits of a free market are always greater than that of a planned economy. A planned economy is a type of economic system where the allocation of capital goods takes place using a centralized economic plan and production plan as those of the Soviet Union. Adam Smith in his book classifies labor as productive and unproductive. He discusses the 3 different sources of revenues: rent, profit and wages, and the taxes that must be paid for each one. He discusses the natural and market price by stating that the quantity of labor was originally the only rule of value, and describes the wages of labor and the inequalities of wages and profits. The principle of the commercial or mercantile system is discussed by admitting that all European nations have tried to accumulate gold and silver, but he warned that the division of labor and free markets creates more wealth than mercantilism. Smith emphasized that once the division of labor is established, it is but a small part of a man's wants, which the product of his own labor can supply. So therefore every man should live exchanging, and the whole society should become a commercial society. David Ricardo believed the theory of value of goods is proportional to how much labor was required to produce it. He promoted the idea that wages must be the minimum to provide subsistence. In social sciences, it explains why people value things differently. Marxian economists refer to it as use value, or the labor theory of value. The theory of value states that the value of a good could be measured by the labor that it took to produce it. The theory states that the costs should not be based on the compensation paid, but on the total cost of production. The comparative advantage theory explains differences in terms of relative and absolute differences in productivity in different countries. The theory attributes the cause of benefits or international trade to the differences in the relative opportunity costs, or costs in terms of other goods given up of producing the same commodities among countries. Countries can benefit by specializing in the production of goods for which they have relative lower opportunity costs, even if they do not have an absolute advantage in the production of any particular good. In that sense, Ricardo is associated with the net benefits of free trade and the detriment of protectionist policies. The theory of rents is defined as the surplus of the producer or differential gain, and it is found in land only. The theory of rents shows that the benefits on a rise in grain prices will tend to accrue to the owners of agricultural lands in the form of rents, paid by tenant farmers. The law of diminishing returns or marginal return states that profits or benefits gained from something will be proportionally smaller as more money or energy is invested in it. In other words, it applies that after an optimal level of production is achieved, the addition of any factor of production will decrease the yields per unit incremental returns. Ricardian equivalence theory emphasizes that financing government spending out of current taxes and current deficits will have equivalent effects on the overall economy. So, if a government engages in deficit spending to boost the economy, then private spending will just fall by an equivalent amount of people save more, and the net effect on the aggregate economy will be a wash. David Ricardo opposed Corn Laws in Great Britain, which were leading to the stagnation of the British economy. He believed that landlords tended to squander their wealth in luxuries rather than invest. Ricardo formulated in his Iron Law of Wages, stating that all attempts to improve the real income of workers were futile, and that wages would remain near the subsistence level. Jean-Baptiste Say. Say was in favor of competition, free trade, and not putting restrictions on business activities. He was one of the first economists to study entrepreneurship, or the creation or extraction of value by conceptualizing them as organizers and leaders of the economy. The school of tradition was the French liberal school, and he was influenced by Adam Smith and Richard Cantillon. The first is the father of classical economics, and the second had been a cradle of political economy, explaining how changes in the supply of money in an economy can affect the prices of different goods in different proportions. Say popularized the law of markets, or Say's law, stating that aggregate supply creates its own aggregate demand. The law of market says that the income generated by past production and sale of goods is the source of spending that creates demand to purchase current production. The law clearly identifies the ability to purchase something depends also on the ability to produce and generate income. Even though many modern economists have developed alternative versions of Say's law. Aggregate supply is the total supply of goods and services, the total amount of goods that firms are willing and able to sell at a given price. Aggregate demand is the domestic final demand, or the total demand for final goods and services in an economy at a given time. Thomas Robert Malthus. He observed that the increase in the population multiplies exponentially, increasing more rapidly, while the production of food grows only in linear form. The work of Thomas Malthus served as an inspiration to Charles Darwin on natural selection, but the Malthusian collapse, just like the predictions and economic ideas of Karl Marx, have been proven wrong. To predict the future is very elusive and not easily accomplished. The world average life expectancy of humans in the years of Malthus was only 30 years. In the 1950s, the average in the world was 46 years, and in 2019, the average is 72 years. His calculations demonstrated that while food supply grew, the populations tended to grow faster. With time, Malthus had been discredited. He did not anticipate powerful new vaccines like smallpox, changes that were brought by the Industrial Revolution, and improved healthcare systems. Thomas Malthus criticized the Poor Laws, a system of poor relief in England and Wales, for leading to inflation rather than improving the well-being of the poor. Those laws had been developed out of the codification of late medieval and Tudor-era laws in 1587 to 1598. He also supported taxes on grain imports, the Corn Laws. He was a supporter of protectionist corn laws. John Stuart Mill, strong proponent of utilitarianism previously founded by Jeremy Bentham. This doctrine implies that the actions are useful if they are for the benefit of the majority. It promotes happiness for the greatest number of people. His economic philosophy emphasizes the use of free markets. However, he accepted interventions in the economy such as tax and alcohol. He did not believe that an equality of taxation meant equality of sacrifice. He also agreed that inheritance should be taxed. At the end of his life, Mill became critical of economic liberalism, the system that supports private economy and market economy. The political and economic ideology that all major classical economists reported in here strongly supports. A market economy and private economy as a means of production has been accepted for the first classical economists, but with different social changes like the French Revolution and economic ideas of Karl Marx, some of these thinkers like John Stuart Mill and the Count Henri Saint-Simon, which included some social liberalism to economic theories. He changed his views on political economy towards a form of liberal socialism, which supports a mixed economy that includes private property with strong government regulation. His approach to economics was mainly based on his belief in the superiority of socialism, in which economic production would be driven by cooperatives owned by the workers. From that point on, economic liberalism and social liberalism went sometimes different routes. Henri Saint-Simon, French political, economic, and social theorist, creating a political and economic ideology claiming that the working industrial class needed to be recognized and fulfilled to have an effective society and economy. His economic ideology, called Saint-Simonism, inspired both Marxism and the anarchism of Joseph Proudhon. One of the founders of Christian socialism, utopian socialism, who was more a social theorist than an economist. Even though he was an aristocrat, he mentions the idling class, a group of parasitic the aristocrats and the clerics who benefit from the work of others while seeking to avoid the work. He called this group the natural laziness of humanity. He stressed the need for the recognition of the individual. Meritocracy is his main political system in which an individual is vested based on talent. He criticized any expansion of government intervention in the economy and that the industrial economy was going to decline because of direct government intervention. He was a proponent of utopian socialism, which is a presentation of visions and outlines for imaginary or futuristic ideal societies. He claimed that feudal society needed to be transformed into an industrial society. Just like the French philosopher Jean-Jacques Rousseau, he is considered an idealist. Alfred Marshall. He was the interpreter of partial equilibrium, which takes into consideration only a part while analyzing wants and necessities, comforts and luxuries, instead of general equilibrium. He wanted to establish a more rigorous level of mathematics in economics. Consumer surplus is an economic measurement of consumer benefits. It happens when the price that consumers pay for a product or service is less than the price they're willing to pay. Marshall economics were extensions and refinements of the work of the previous four economists discussed. For him, the prices of commodities are determined by supply curves. He developed a supply and demand curve that is still used to demonstrate the point at which the market is in equilibrium. He was the first to develop standard supply and demand graphs, which is a standard practice in most economics books. Supply curves represents the correlation between the cost of a good or service and the quantity supplied for a given period. Marshall added the term consumer surplus as well as concepts such as diminishing returns and marginal utility to the field of economics. He studied the fact why an excess price is paid instead of the price willing to pay. In that regard, he discussed the sale price of a product must be high enough to cover such a replacement cost. Karl Marx, one of the most influential economic philosophers in history, not because he had great ideas of economics, but because he used a social economic analysis of societies that uses economics in the study of society. He developed a political and economic theory of society with no social or economic classes. His ideas were more based on the feudal system rather than on the new capitalistic society that was taking form in Europe, especially England with the Industrial Revolution. This new system called capitalism came into place after hundreds of years of a primitive form of communism called feudalism that reduced trade and commerce and created classes with no mobility. Of those classes, Marx was referring to when he wrote his magnus opus called The Capital. He opposed to an economic system of inequality and the alienation and exploitation of the majority by means of a system of wage labor. Marx's theory is about class struggles, political tension between rich and poor, or proletariats and bourgeoisie. He uses Hegel dialectics to create a system called dialectic materialism, studying the historical conflicts between ancient Rome patricians versus plebeians or oligarchs versus commoners. Another economic idea of Marx is surplus value, or the difference between the amount raised through the sale of a product and the amount it costs the owner. The classical economist Alfred Marshall attacks Marx, saying that it is not true that the spinning of a yarn in a factory is the product of the labor and its operatives, but it is also the product of their labor together with that of the employer, the manager and the capital employed. Knut Wicksell. His economic contribution would influence the Keynesian and Austrian schools of economic thought. He was influenced by David Ricardo and Leon Walras from the Lausanne School and wanted to create a synthetic theory of economy. Using David Ricardo's theory on income distribution, he concluded that an economy was not going to equalize wealth. He concluded that wealth created by growth would be distributed to those who had it in the first place. His theory of marginal productivity relates to the idea that payments of factors of production equilibrate to their marginal productivity. The marginal revenue productivity theory of wages is a model of wage level in which they set to match the marginal product of labor, which is the increment to revenues caused by the increment to output produced by the last laborer employed. He invented the term natural rate of interest, or the interest rate that supports the economy at full employment. If the natural rate prices and economic expansion occurs, then ceteris paribus will arise. This provides a new theory called endogenous money. Endogenous money is when the supply of money results in the interactions of other economic variables, rather than exogenously, autonomously, by an external central bank. Marginalistic theory of value. Leon Walras, Carl Menger, William Stanford Jevons. The work of these three economists, Leon Walras in Switzerland, Carl Menger in Vienna, and William Stanford Jevons in London, marked a new period of economic thought. According to Jevons, the theory of utility is a continuous mathematical function of the quantity of the commodity available. For him, goods provide utilities or units of utility. This theory of utility was also being independently developed by Leon Walras and Carl Menger. The theory of value was demolished by the Austrian school of economics. Every theory of value was objective, only considering the value of a product by its production costs, including labor, materials, and profits. But in 1871, Karl Menger considered the value of good more as a subjective exchange value which depends more on the utility of the commodity than on the production costs. The classical theory of value emphasized that the amount of time it took to produce a good determined the value of the good. Leon Walras' biggest contribution was what is called general equilibrium theory, demonstrating that price and quantity were uniquely determined. From that moment, the mathematization of economics was developed. Menger, on the other hand, rejected the cost of production theories of values that have been previously developed by Adam Smith and David Ricardo, and he developed a subjective theory of value. This subjective theory of value considers that both sides gain from exchange. He thought that goods are valuable because they serve various uses whose importance differs. Therefore opposed William Jevons by not believing that goods provide units of utility. Leon Walras developed a mathematical expression from Adam Smith's conception of how markets will be in equilibrium, creating a balance between supply and demand. He formulated the marginal theory of value independently of the Austrian Karl Menger and another economist called William Stanford Jevons that also expounded the marginal utility theory of value using mathematical methods. The marginal theory of value had been previously explained as the theory explaining the discrepancy in the value of goods and services as they referred. Leon Walras pioneered the development of the general equilibrium theory by emphasizing that Walrasian trial and error to reach market equilibrium. He also contributed to elaborate what later became known as neoclassical synthesis, which was a neo-Keynesian academic movement that wanted to reconcile the macroeconomics thought of John Maynard Keynes with neoclassical economics. This fusion creates the best explanation for short-term fluctuations in the economy. Short-term fluctuation results in the change in the output level. In other words, in the short run, an increase in money will increase production due to a shift in the aggregate supply. More goods are produced because the output is increased, and more goods are bought because of lower prices. Walras' law states the existence of excess supply in one market must be matched by excess demand in another market so that both factors are balanced out. Austrian School of Economics, Karl Menger, Eugene von Bewerk, Ludwig von Mises, and Friedrich Hayek. The Austrian school was founded in 1871 and focuses primarily on methodological issues. It is anti-Keynesian and consistent with the classical economy introduced before. It is considered a justification of libertarian policy conclusions promoting a quantitative theory of money. It also suggests that all prices are determined assuming a constant supply of money, implying that the newly printed money can never represent real productivity. The Austrian school suggests that inflation is never uniform, and they deny the validity of paper money, preferring gold and silver. The Austrian school implies a rational expectation theory which assumes that actors in the market make the best decisions. The actors that make bad decisions are taken out of the competition. The school assumes that economic equilibrium cannot exist because economic conditions are constantly changing. It also rejects aggregate statistics because prices do not have any constant relationship to one another. Since prices are not constant, the school believes that there is no proper objective way of measuring value or wealth over time. Some of the members of the school, like Ludwig Von Mises, warned of the inevitable failure of central economic planning as suggested by Karl Marx, while another member of the Austrian school, Bayer, believed in nationalization, and a debate took place within the school in terms of private property, market capitalism, and aspects such as economic efficiency and supply.